Usually when you hear the phrase regime change, you think about changes in power in government. So this phrase can be applied to financial markets and investing as well. So are we in the early stages of a regime change in the markets? And if we are, what does that mean for the economy? This is a conversation well worth your 10 minutes right here on UBS Trending. Hello, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thank you so much for being with us. I'm here today with Brian Ferguson, lead portfolio manager from Newton Investments, to have an enlightening conversation about economy, large cap, what's going on. There's a lot happening in the markets these days, Brian, so it's good to have you here. But I wanted to ask you, so you talk about a regime change, and I'm using the air quotes. What do you mean by that? Because we're not talking about government.
Yeah, exactly. And, listen, we're really using that as a metaphor to describe a certain behavior or backdrop that was in place for many, many years, and now that's gone. That's in the rearview mirror. And when you look through the windshield looking forward, there's something that's dramatically different than what we've experienced over, let's say, the last 15 years. That's what's happening today in our economy and in the world, and it's perhaps best characterized by free money was there for many, many years. Too bad, too sad, stick a fork in it, it's over. Money is not free anymore. Accept it and get used to it. And if you don't get used to it, there's going to be a real price to pay.
Well, this really ties into what we're looking at every single day here when it comes to monetary policy in the Fed and where rates are in the credit markets. But, before we get into that with you, I wanted to just bring up that you called, that you've got the new economy, you've got the old economy. Looking at the markets, say over the past 2 years, after the pandemic has begun, we've certainly seen a lot of action with what Jay Powell and the Fed have been doing. You say the old economy has made a comeback. Why do you say that? Yeah,
and this really ties into that regime change. Free money for about 15 years, and just now, this is chapter one here,
right,
of not having that free money. And so if we look back for the majority of the 15 years, money was free, fast and easy, free and loose. That's gone. But part of the reason why that it resulted in an over-investing in the new economy was that with zero cost of capital, unlimited funds being directed at the investment into the new economy, because it was so obvious that that is the future. And therefore, an incredible amount of capital with no constraints because the cost of capital was very low. And just to contrast it, we spent that same period of time underinvesting in the old economy because, for many things, use energy as an example. It was so obvious that by lunchtime tomorrow, we're not going to need oil. Now, we know that's not true.
Of course, right.
But that really drove perception. And quite frankly, when we look at investing, it's all about supply and demand. So too much money chasing things, even if those are a lot of things, in the case of, let's say, the new economy, that's really going to drive down returns and can end badly. And the same goes true for too little money chasing something. Well, that's going to dramatically change the supply picture. And I think best characterized as well with energy, and I would say the punchline is that, the perception and or the reality is we're going to run out of supply before we actually run out of demand, which may occur in 20, 30 years.
Right. Not by lunchtime, that's for sure.
That's right.
Right. But I know that you and your team are really talking to clients about large cap value, which is an area that we talk about quite a lot on the show here. So given your, what we're talking about here, where do you see the best value right now within the large cap space?
Yeah, so, back, in those 15 years post the great financial crisis when growth was scarce, that's all anybody wanted.
That's right.
Every day. Every year was like Groundhog Day, Groundhog Year. And it was just give me growth, give me bond proxies, give me quality, because there was very little growth. and there was very little inflation, and interest rates were very low. And I get it. I mean, I like growth. I like growth and cash flow. I like quality. But as a value manager, it just matters what you're paying for something. If you're paying too much for something, that is going to end badly. And I think that's what's just started. And of course, you know what? The pandemic really complicated things, because not only did we have excessive valuations in those factors, but we had that unusual period, and I like to call it the pandemic palooza, in which we pulled forward so much demand for things in and around the new economy. I think it was one of the leading CEOs of one of the tech companies, and I think a lot of them said it, and it was, and if they didn't say it, they believed it. We had 20 years of digitization in about 20 months. And so if everybody bought a PC and everybody bought a brand new exercise bike when the house was the home, the office, the vacation, and everything else in between, and the world started coming back to normal, you moved from the pandemic palooza to the pandemic palooza hangover.
Right.
And that's what we're in now.
Right, and it's interesting because obviously tech was a big thing that I think a lot of folks can relate to.
Right.
As you mentioned, our homes became everything: school, work, gym, and we all bought equipment to keep up with our work demands, school demands. And of course, we see now a lot of these large tech companies are starting to lay off people because they're coming down from that high of being so in demand from those 2 or 3 years ago. But now we've got this issue with the banks as well, because we've had one run on a bank recently, Silicon Valley National, and now people are worried that that could spread. At least I think we're controlling those fears. But when you look at the overall large cap value, does that impact your thoughts on the banks that you have, those high quality banks, or is it really just contained to those small regional names?
Yeah, listen, it's a fluid situation. We're going to have to monitor it as always. But right now, our thoughts are that the big banks are winners. They're going to get bigger. The problem is really with the non-regulated financials or the less regulated financials. And ironically enough, the Silicon Valley situation, guess what? Sure, it's a bank, but that was really a bastion, a beneficiary of free money. And it's really about overinvesting in the new economy.
That's
because
right.
Guess what? The concentration of their assets and liabilities all come from what? The new economy,
That's right.
the venture capital
It ties
industry.
right into what you're talking about today, which is
Exactly.
perfect, right? And it's great for our viewers who are a little bit worried about what's going on out there, and maybe it'll allay some fears. We've got about 30 seconds left. Brian, where do you recommend people are putting their money to work within large cap value? What are some of the sectors that you think these are home runs here?
Yeah. So we talked about energy earlier.
Right.
I think it's one of the best opportunities. Typically, the best opportunities come from bastions of skepticism, but guess what? Things do change. And the big changes that we're seeing in energy are, point number one, they're not overinvesting in supply. Their old business model was generate cash, take all that cash, put it back into the ground for more supply, and then you ended up having a supply problem right at the point in time where demand started diminishing.
That's exactly right.
Incentives drive behavior. They shifted to a focus, and capital markets demanded this. They shifted to a focus on returns on and of capital. So one, investors are really underestimating the benefits of a much better supply outlook. Point two, unlike many decades in the past, their balance sheets are the best they've been in decades. There are many energy companies that actually have positive net cash, which it almost sounds odd to say those things in the same sentence, but it's happening now. And then there's one other element, which is OPEC is back in charge. And that wasn't the case when the industry didn't have the discipline, because when prices went up, they'd go over to this thing called the shale switch, and they'd switch it on the on, and then 9 months later, out of the Permian, Haynesville, and other, a lot of supply would come on, and so that would drive oil prices down. And guess what? OPEC didn't cut because they were afraid of losing share. That shale switch is in the off position. OPEC's back in charge. And so there is a really wonderful supply picture with better returns on and of capital, and quite frankly, best balance sheets the industry's really ever had.
Excellent. Brian, we got to leave it there, but thank you for that today. And I like the old economy, new economy. It's happening right now in front of our very eyes, so good to be with you.
That's right. We just started.
That's right. Exactly. We'll see where this goes next. Thank you very much to Brian Ferguson. And thank you for joining us. For more information, visit ubs.com/views, and also make sure to follow us on our newly relaunched UBS Trending Instagram account at UBS Trending, right there on Instagram. Some great content and some sound bites and other info for you. And if you have any questions about your portfolio, make sure to speak with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.